Hi everyone. In this video, we are going to be covering section 6.3 of the textbook. It's about taxes and how to account for the PST specifically. Accounting for taxes is not that difficult. It's way less annoying than having to actually pay your taxes. We are going to cover PST and GST separately since that's how the textbook does it. Also, there are still provinces in Canada that use the two taxes separately. So we will be looking at PST first. This video is all about PST, and we'll look at GST later in class once we've mastered how to analyze transactions with PST in them. In Ontario, we obviously don't use PST and GST separately, but we have the HST, which is the harmonized sales tax. The harmonized sales tax we won't worry about too much right away. I will show you, or I will tell you how to do the accounting for the HST. The accounting for the HST is really simple once you figure out how to do it for the PST and GST because it is split up anyway. So we won't be worried too much about that for now. The only thing that we need to learn right now is how to account for PST and how to account for GST. To begin, we're going to look at a quick background at sales tax and what taxes are in general. As you know, tax is a way for the provincial government or even the federal government to raise funds and collect money in order to provide services to the people within that province or country. There are many regulations associated with taxes, and they could change at any time whenever the provincial government passes a new law. In this course, we're going to look at sales tax in its most simplest form. A retail sales tax, which is essentially PST, is charged by most provincial governments. A retail sales tax is a percentage tax based on the price of goods sold to a customer. The tax is added to the price and paid by the customer. So in other words, when you go out to a store and you purchase a shirt or pants or any item, there is a tax on that item, which the customer pays for when they pay their total price for that item. Hence, the current practice in Canada is to tax the final customer only. A sale from a wholesaler to a retailer is not subject to provincial sales tax. So if there's one business selling an item to another business, provincial sales tax will not be paid in that case. This will then, it's going to be taxed a little bit differently when this happens. And when we look at GST, that's when we're going to start looking at when businesses sell to other businesses. When accounting for the PST, the individual, firstly, who bought the item will do absolutely no accounting for the tax. In other words, the purchaser does not do any accounting for the tax that they paid on the item that they bought. They just account for the full amount that they paid for in their books. So if you go to a store and you purchase items, you're not going to calculate the provincial sales tax and reflect that into your books. You're just going to list the total amount that you've purchased in your books. However, it's a little different if you're the retailer selling the item. If you're the retailer and selling the item, you must account for the PST that you're charging others in your books. It's the responsibility of the seller to administer the sales tax. The seller must calculate the tax and add it to the normal price of the goods sold. This is usually reflected on the receipt. When you purchase an item, it gives you a subtotal, the tax that you're paying, and the final total. You must collect the tax from the customer when they pay for the item that they've purchased from you, and then you must accumulate the sales tax charged to the customers in a special liability account called PST payable. PST payable is a new account that we're going to be now using when we are accounting for our sales taxes. Any sales that we've made as a company, we are going to be calculating the PST that we are going to be giving to the government that we have collected from the goods that we've sold. And every month or so, we're going to calculate all of the PST that we've collected from every single sale, and we're going to give it to the government. We will go over that a little bit in the next few slides. But for now, all you need to know is that if you're selling the item, you must calculate the tax for it. So here's an example of what accounting for PST will look like in the books of the seller. Here's a source document for a cash sale that Morris Marina made to S. Pratt. As you can see that the company here sold S. Pratt 2 items. The subtotal comes to $199. Now, the tax is 8% in this case. This means that 8% of $199 is $15.92. That is how much tax the company must collect and give to the government. The total is going to then be $214.92. The customer is going to pay the full $214.92. We, the company, will keep $199 because that's how much money we actually sold our product for. And we will give the government $15.92 when it's due on that monthly basis. The transaction will look like so. Our bank is going to be increasing by the full amount, which is $214.92. Our sales is also going to be increasing by the amount that the sale was for, which was $199. And our PST payable account will also be increasing by $15.92 because that's how much money we now have to give to the government. We are liable to pay that at some point. Here's another example of PST being accounted for. Here's a sales invoice from Sports Equipment Limited. The sale was made on account. As you can see that our company, Sales Equipment Limited, sold items to Marathon Recreation. We sold 3 items. The subtotal came to $321.75. We applied a tax at 8% of $25.74, and the total came to $347.49. Now, since this is a sales invoice and it's on account, this means that Marathon Recreation still owes us money. Now, the transaction is going to look like this. Our accounts receivable is going to be for Marathon Recreation. It's going to be increasing because they owe us the full amount. Sales is also going to be increasing, so it's going to be credited. It will be increasing by the subtotal, which is $321.75, because that's what the total of all the items, that's what it came to. And our PST payable is also going to be increasing. Hence, again, it's going to be a credit. It's going to be a credited transaction because our liabilities are increasing, and they're increasing by $25.74. Now that you've seen how PST is accounted for in the books of the seller after a transaction occurs, the second thing that happens with the PST is that it is remitted by the seller. PST is collected monthly by the government from retailers, and when this happens, retailers must reflect this in their books. They must show that they are paying for their PST. For example, say that we collected $415.23 worth of PST in a month. We must give this back to the government. The transaction will affect the PST payable account as we are moving money out of it, and the bank account as we are paying our PST payable. So our PST payable will decrease, which will debit our PST account, and our bank will decrease as well, which will credit our bank account. Again, this transaction will only happen once a month. This ends our video on accounting for PST. Be sure to complete the module, and in class we will do a quick review of this video and practice transactions with PST before moving forward with GST.